Hey everyone, how's it going today? As you can see, this is another episode of Behind the Door. We are on episode 4. We haven't stopped, we keep going. And as you can see, we got different faces this time. We got a lot of good topics, guys with a lot of experience in what they do as far as real estate. So what I'm gonna do first, well, what I'm gonna tell you guys first, I need you guys to subscribe to the channel. If you subscribe to the channel, anytime we go ahead and we put out content, you'll be the first one to get it. And if you can, share it to someone who likes real estate. We're on this platform to talk about what we really do. There's no mysteries, there's no make believe. I make sure I vet people that come on here and we actually talk about what we do. So, with that being said, Fred, if you want to introduce yourself to the audience, and then we'll just go in a circle from there.
All right. I'll one up and say, hey, if you subscribe, take a look at the content. How about you like a few of those things? Those things, yeah, Gus puts out some good content. So I just want to make sure everyone gets to see it. So hit a like on one of them videos.
I'm gonna have to clip that as a reel, okay? But go ahead.
All right. So thanks for having me on, Gus. It's great to be on a panel of esteemed gentlemen right there. So my name is Fred Jacquet. I'm all the things. I'm a dad. I'm a son. I'm a husband. I'm a native New Yorker. I've been in Connecticut for about 15 years, but I'm still claiming New York to the end. By day, I have a 9 to 5. Been in companies, been working in a 9 to 5 for many years now. And by the grace of God, I've been able to do it from home since COVID-19. What I do by night, I acquire discounted properties, renovate them, and hold them as long-term rentals. About 5 years ago, I realized I had some commitment issues. So I switched it up, changed the strategy, and went to midterm rentals. And this is where I fully furnish, I provide fully furnished accommodations to travel medical personnel. Um, Also, I have some office. I have an office building that I rent out, as well as a garage. So I'll keep it short.
Man, that's kind of hard to follow up after, Fred. I'll keep mine simple. Ray Glymph from homeless to over 100 doors. I currently own and manage over 100 and some change units right now. Anything from single family, multifamily, large buildings, commercial, mixed use. Mostly long term is my focus, but I do short term as well, midterm. Anything from office space to your mom and pop coffee shop, or is all in my portfolio. So happy to be on this panel and hopefully lend a hand.
Hey everybody, I'm Eddie Gonnella. I'm born and raised in Central Maine, and I own a real estate portfolio split between small residential long-term rentals and short-term rentals. And then I own a short-term rental management business where I manage my own short-term rentals and manage for some other people as well.
All right, so you got everyone's background a little bit. So we're just going to dive into the first question. Now, especially right now with a lot of things that are going on in the country, we're not here to get into the politics side of things, but interest rates, where are they going? And us as being investors still active in the game, does that alter our cash flow versus appreciation purchases? Obviously, we would like to have both, but with interest rates increasing, does that affect how you're currently buying, and where do you see yourself in 2026 as far as purchasing? Eddie, we'll start with you.
Yeah, good question. I try not to try to predict the future, so I kind of look at where the market is right now and make sure that anything I buy works for today. Obviously I'm thinking long term. Everything I buy with the intention to hold for 20 to 30 years. I'm a relatively young professional, so I'm going to hold these properties for as long as possible. And so, I know that if they work today from a cash flow perspective at today's interest rates, and I can get some good fixed interest debt, then in 20 to 30 years, they're only going to work even better as I see rent growth and appreciation over time. But generally, I'm a cash flow investor, so I want to see that the deal works today, with whatever the environment is, whatever the rents are today, whatever the interest rates are today, and then I'm going to hold it for a long time. And over time, you know, if you look at history, rents are going to go up at least a little bit and appreciation is going to happen a little bit as well. But I'm really looking at the deal today, make sure it works. And so I'm still buying, certainly not as much as when interest rates were like 3%. The deals don't quite pencil as good as they did at that time, but I'm still buying. And if the deal works today, I'm still buying it. So.
And if you don't mind me asking, what interest rates are you currently seeing right now, on your end? I know you're penciling deals as far as underwriting. What are you factoring in as when it comes to the interest rate?
Yeah, it depends on the property if it's going to be a commercial loan or a conventional loan. On the conventional side, I'm seeing around like 6% right now. So that's like a conventional 30-year loan on a single family. On the commercial side, I'm seeing more like 7.25%. That's the most recent refinance I did was at 7.25. That's a 25-year commercial mortgage with a 5-year fixed interest rate. So that's pretty much what I'm seeing. I've also been dabbling in some, they call it the debt service coverage ratio loans. So I've been doing a few of those, and I just got a loan sheet for one of those. It was around 6.5%, and that's 30-year fixed on, it's still a commercial mortgage, but it's 30-year fixed and 6.5%.
All right, we'll circle back to that. I want to bring that up. But Ray, what about the question I originally asked? Interest rates, how's it affecting you right now?
Yeah, I want to say, one, if your strategy is to buy and hold, interest rates should not matter as much as long as the deal cash flows. That is the most important part is if the cash flows in interest rates. Now, if you got long-term debt too, we got to focus on that because when you think commercial, you got to play the 5-year game. And, a lot of people in the commercial space, and this is why we're seeing defaults, a lot of people in commercial space didn't think that interest rates could ever go to 9%. So they bought with 5% during COVID time because we're at the refinance period. Every 5 years, you have to refinance commercials, typically how it goes. So a lot of guys bought in that 3 year and thought the 3 year percent interest rate, maybe max five, and then they got hit with 9%. So when you're running your numbers, please run your numbers tight. Make sure that the numbers can adjust. There is room for increase. And interest rates don't really factor as much. Of course, they're part of numbers. But think about the longevity of rent. Right now, everybody, a lot of people I know in our group thought rents would continue to go up, and we've seen some flattening. We've seen a lot of pullback in some areas as far as rent goes too. So, interest rates are just one part of the underwriting process. I don't hold it higher than any other. Honestly, I think it's just one of the lowest actually, in consideration. The number one is does it cash flow? Does it actually make money? Does the deal make sense?
I do want to ask you and Eddie a question because you both do commercial loans, and I'm sure you did it early on 2000 in the 2020s. So that 5-year time period has passed now. I'm sure you got some phenomenal rates at that time. Now with it changing, have you refied or have you kept it the same? Because from my bank, and I'll use an example, I technically don't have to refi. I can go into the next term with that being a variable rate. Probably not the most safest thing in the world, but that's where I am currently. So for both of you, where are your commercial loans at? The ones that have gone past the 5-year marker?
Yeah, I could speak on one. I just had one that went from think like a 2.9 to a 7. Well, they tried to hit me with a 7.5. We got them down to a 7. But here's the deal, that property the cash flow is phenomenal on it. So going from a $600 bump doesn't really move me. It doesn't really stop the property. It doesn't make it stop cash flowing. I'm at the point where I could refinance, but I don't know if I really want to. We're still cash flowing great. Doing a refi, pretty much a pull cash. I don't really need the cash necessarily. So it doesn't really move me. Rates are the rates, and it's just something we got to pay. Expenses are going up, so how do we, limit the expenses is the biggest thing I'm thinking.
Yeah, Gus, similar to you, when I do the commercial mortgages, I'm really keeping an eye on that 5-year mark and making sure it's not necessarily a balloon payment. Because if you look at some commercial mortgages at 5 years, you actually have to pay that back to the bank. And you assume that they'll refinance it, but there's always a chance that they don't. And so I'm looking for commercial mortgages that instead of a balloon payment at that 5 years, it just automatically resets to a new rate for another 5 years. So that's usually what I'm looking for on a commercial loan. I want to avoid those 5-year balloon payments if possible.
And Ray just brought up an example of one of his properties increasing $600 as far as payments. Do you, with some of the ones that you had expire, any big jumps as far as mortgage wise?
Yeah, for sure. I just had one from 2020. I think we had it at 4% and it went up to that 7.5%. So, thankfully we were cash flowing. I think before this is a single family home. I think the cash flow before was around 500 per month, and that payment went up by 200. So, it's eaten into the cash flow a bit, but like Ray mentioned, like you need to underwrite these deals with some room for that to happen, especially if you do have a 5 year adjustable rate mortgage. So at the time, definitely knew that it could withstand a little bit of an increase. And of course, over those 5 years, we've also seen some rent increase, and that helps as well.
And I was just going to speak about that. So I had one last August that expired and it went to a variable rate. It went from 4.25 to 7.5 and then increased 400 and some change. But then I saw what I originally had for rent and then what my rents are now, that increased like almost $2,000. So for at least for that building, I only speak for that building, that's not really affecting me. Now, in that 5 period time gap, did insurance go up a little bit? Yeah. Did taxes go up a little bit? Yeah. But and I didn't even underwrite that one. I'm gonna be honest with you. That was one that it was a 5 unit. I was like, yo, this is a good deal. And I may look like a superstar here. Right now it's about 575 as far as what it's worth. I brought it at 280. I put 20% down. So right now it's a good asset. It looked like I was a pro, but actuality, it was just the opportunity that I had. So I think a lot of people are running into that. They took advantage of some buildings and it's working out for them now. No telling what's going to happen in the future. I'm going to stay with you guys. One more thing I want to ask. Ray, you brought up um, some people they're going to be hurting once things expire. How can that be? We just brought examples where it hasn't hurt us. How can it hurt, other investors where it's going to be a fire sale potentially?
Yeah, let me I want to give a caveat too, because you mentioned your rate went from, 4 to 7.5. That rate isn't fixed, ladies and gentlemen. So go back to your lender, negotiate with them. Hey, look, I'll pull this loan. I need to be at 7. I'm seeing other numbers at 7. Can you get me to 7? 7.5 is to someone off the street. I was able to negotiate mine from that 7.5 down to 7. It's only half a point. But what they send you isn't written in stone. So I think that's very important for everybody to know. Right now, there is a little bit of a credit crisis, but lenders are doing something called extend and pretend, where they know people are like underwater. Instead of causing this crisis, they're letting it kind of just go. They're letting it go. They're letting people, as long as they're making their payments are, up to date. Lenders are allowing it to go. Um, we aren't seeing, I know, especially in the credit or in the commercial side, I'm not seeing a ton of foreclosures, but assets are trading. They're trading quietly. So as an investor, this is going to be your time to make sure that you can go to mom and pop and other investors and make those deals. Because it's happening quietly, it's happening behind the scenes. Um, for somebody who bought with no equity and there's not as much appreciation or not as much rent growth as they thought, they're kind of screwed. So at that point, they're trading assets. We've had a lot of growth though through COVID, right? From that 5 year run. Because I think the 5 year run is 2021. COVID happened in what, 2019, 2020. So we've had a lot of growth through that time. So a lot of people are being saved by appreciation, but I think we'll start to see more of a crunch. It's coming.
Dope, dope. So I did want to get your guys' expertise on the commercial loan and going with fixed 3 to 5 rates as far as that. I know, Fred, you purchased your property a little bit different. So back to the original question, as far as interest rates, how's that affected your buying currently? Are you still looking for cash flow, still looking for appreciation? Where are you at with things?
Okay. Well, before I lose a couple of points, I liked a few things that Ray as well as Eddie said. One, I think Ray, you talked about the rate. So I got a HELOC at the end of last year. And I was like, okay, I got the HELOC and I was ready to move. I moved on, didn't worry about it. This year, I reached out to that same lender to find out about a refi. And he's like, he couldn't help me with the refi, but then he said, hey, I'm just letting you know there's something that the bank is doing. And then for the next, I think Q1 or Q2, they reduced the rate by a quarter of a point. And he said, all you have to do is apply. I didn't have to pay for anything else because I had a VA exemption, so I didn't have to pay for the fee. And he pretty much just said, all I have to do is submit the paperwork and I get a rate reduction. I'm in the middle of it now, but again, it's like there is flexibility in there. But when they talk to you, they make it seem like this is it, and there's no questions to be asked, but definitely ask the question. And Eddie, you mentioned pretty much like stress testing. Like whenever you're doing your underwriting, how do you fluctuate the different variables to see what happens if something changed? Now, this is doomsday planning. It's like, oh, if something went wrong, if interest rates jumped up this much, what would happen to, my investment decision now? Or if rents jumped up a certain amount, what would happen to my investment decision? So I think you both hit on those points, and I just wanted to write it down and just kind of point out that those are pretty valid, and everyone has to think about it, although they're probably not because they're focusing on other elements. Now for me, again, I mentioned I'm a BRRRR investor, so I buy discounted properties. So that first piece of buying discounted properties means that I'm already going into the game with my idea of appreciation. I'm not planning. I'm not looking for the future to create appreciation for me. I'm trying to find that situation where I'm buying the property at a certain number so that it's already built in for me. It's like, if I get the property at this much, I put this much in terms of a renovation, and if I refinance and cover all of that, everything else is goodness, right? It's funds that I got out of the deal that now I pulled my funds out, and it's funds that I have in the deal for future. So that's one piece, and the other piece is, like I mentioned, my dad, I'm a husband, everything else. So I'm looking for stability. I got out of the stock market because I don't like volatility. So I sold what I had in the retirement, and I put a property in there because the reason it went up or down is because of tenant left. Right. That's all. I want to keep it as simple as possible. I don't know if it's older age or whatever, but I'm just like, I just want that stability. I still want the growth. I'm still going to take the aggressive steps now, but I want that stability to know these are the variables that can change, and this is what I do. This is what I do to adjust to it right now. It's not like I had Amazon, and then someone cheated on their wife, and all of a sudden it went up and down. Like all those things, I'm done with. So I'm all about the cash flow now to make sure I have that feeling of stability and appreciation. We're making the right decisions now, so hopefully I'm in the right market. But if you're not in the right market, appreciation is not it. But it's really, I feel like cash flow allows me to sleep at night. Appreciation is goodness when it's time to sell.
No, I like those answers. I even like the example that you brought up with Amazon.
Okay.
What I also want to ask you, so you started investing when? Remind me.
This was a 20, well, it would have been 2017. But when I told my wife I was going to start investing, she said, we better buy a house first. So it ended up being 2018. But I did buy a house in 2017.
Okay.
But it was our own personal residence. So I like to say my first investment was a single family rental, and then I moved into it. Then
Okay.
I get the weird looks.
Okay. Okay. So, and how you go back, you go ahead and purchase properties. Talk to me about the financing. Is that because you told me you refi
Mhm.
with the Burr process? What were you looking at 2018, 2019, 20? What were you seeing as far as interest rates now? And what were you seeing as far as not now, at that particular time in cash flow? What is it compared now?
Mm. Okay, so I gotta say, when I started out, I was figuring things out, right? So I know when I went to the deal, so how I find my deals, I don't know if you touch on that. So back then, I went to this seminar, I went to a hotel and all that stuff, and didn't increase my credit limit and get a package, but I realized that there's other ways to buy property. So I was running the neighborhood because I was training for the marathon, running the neighborhood, found properties, sent them notes, got responses back. I was expecting to be a wholesaler, didn't quite happen because I didn't have my seller's list. So I got the property under contract. Then I was like, okay, let me go find a buyer. It was too late at that point. So, but I told whoever came and asked if they're interested, they can come. They can close on it now. If not, I'm doing it myself. And then I ended up doing it myself. There were a few things that didn't happen. Didn't have everything all set up, so I ended up having to get hard money, which again, we talk about financing. First opportunity to kind of get into a deal that was if we're looking at rates, it was I want to say it was a 12 point 12% 1 point. But that's because something else fell through, and it was either that or I wouldn't be closing on a deal. So through connections, at least got that. So we're talking about me going into a deal at 12%. The good thing is, when I got the property, I'm a numbers guy. I looked at it, I was like, okay, I got it for 122. I looked at what the appraisal should be. I was like, you know what? If this were fixed up, it should be closer to 250. So I'm looking at the numbers. I'm like, this seems like there's a lot of room to make mistakes. And so that went into the deal. 11 months later, made mistakes, but 11 months later got out of it. when I did the refinance. I want to say it was in the fives. And in front, I don't have it in front of me right now, but it was in the fives. When I refinanced out, I think it was a DSCR loan. Um, and so now comparing that, I want to say 2 years later, I refinanced again. Actually, I don't have that in front of me. But that was in 2020. So when I first refinanced, I still left maybe 5K in the deal. When I went to 2021, the property value had already gone to like 295. So there was plenty, it was plenty in there. And the rate was lower than the five. I just don't remember what it was now, but it's gone down since. And I know when I bought another property, it was when I bought my own personal property during COVID, it was two something. So the rates, I'm not necessarily focusing on it because it's about the cash flow. It's been cash flowing ever since, and I've had the same tenant ever since. So I'm not worried about it as long as it's covering itself. I'm paying my bills, and I can see it continuing to appreciate is a good sign that I was doing the right things.
Nice, nice, nice. Yeah, that 12% for the hard money. And for people watching this, so I want to throw this out there. We're experienced investors, so hard money and private money, we understand what that is. But I will tell you, some people still don't know what those things are. They're thinking if I don't go get a FHA or a conventional loan, I can't buy a house. Some people who are inspiring to be investors. And I think the farthest they know is commercial lending. Those are the two options I tend to hear that are the basic level. So when we talk about hard money and what was it, the DSCR loans, those are something I think aren't as much aren't as known as those other ones. So I want to ask because I know Eddie, you use hard money too, correct?
Yeah.
And Ray, you use hard money. So does anyone want to explain what hard money is to our audience? We'll start with that first.
So pretty much it's going to be unconventional. Any other form versus traditional lending is how I view hard money. Um, it's going to have higher interest rates, but most of the time it's not underwritten as much, and pretty much easier to get in and out of. So if you go traditional route, you're going to have banking. They're going to want to see 2 years bank statements. Where if you go hard money, some people call it hard money is DSCR lending. Um, Pretty much they're going to base it on the asset only. They want your credit score because that's going to determine their, interest rate, whether they'll loan to you as well. But it's going to be any non-traditional banking course, which is easier to get in and out of. Um, with banking, I'll get into the weeds, but with banking, they have pretty much a board of members. They have to vote on whatever, lending that you want to do. So if you present a bank and say, "Hey, I want to do this," they'll have to take it to whatever board they have and say, yes, we'll allow the loan on this. With private money or DSCR loans, it's pretty much just straight, hey, this is good. We underwrite it. It's fine. Let's go. So much easier to get in and out.
So what made you go? So when you brought so who brought, did anyone buy their first place with a hard money or DSCR loan? Or were you guys all more traditional?
My first home and investment was traditional
Okay.
commercial banks.
Okay, so let me stay with you then. What made you start going to the route of hard money when you
Cap,
went traditional?
yeah. I capped out. So most banks will only lend you a certain amount, and then they have to go to a certain, especially if you're working with smaller banks. Like my first smaller bank, the most they could lend was like $2 or $4 million. And the way I was growing, it was like, hey, Mr. Glymph, like we can still work with you, but we're gonna have to get with our sister bank to work with you. And so I was like, well, if you get a sister bank, that means I'm paying a middleman, right? And whenever you pay a middleman, you're paying a little bit more than what you should be paying. So at that point, I'm like, I gotta go right to the distributor. And then I found that there was other forms of payments to be worked out with better terms, honestly.
So you found that out by research, or did you know people who had the connection to those people?
No, I found it out by research because, like I said, it came to the point like I needed to get into a deal. The bank was taking forever. So I honestly hopped on Google. Other means of lending. And those people, they are snipers, man. They want money to be lent. Banks don't make money unless they lend to you. And especially when you're going like non-traditional banking, they want to lend to you. That is their sole purpose is to lend you and they sell it to, Freddie and Fannie.
Eddie, what about your experience with hard money, especially private hard money and those avenues early on?
Yeah, for me, I started with conventional loans, just doing like a house hack. But then quickly, as I got into the Burr method, what you find is like a bank doesn't want a loan on those really distressed assets. So like my second property was an auction property, like bought it sight unseen. Like there was like rain coming in the house when we walked in. And like there's no bank that I know of that wants to give you a loan on that kind of property. So for that, I had to go hard money. So that was a private individual who, they've accumulated enough wealth where they want to give out small loans to real estate investors at higher interest rates. And, so I had to go to hard money and private loans because the banks aren't going to want to lend on really distressed assets. So usually what you find is with that hard money, it's going to be like a shorter term, like usually it's 6 to 12 months. You've got to pay it back in 6 to 12 months. The interest rate is probably going to be higher, like Fred mentioned, like 10 to 12%. You can see that for hard money. And then you're also usually going to have to pay some kind of origination fee. So that's kind of how the lender makes money, right? It's pretty risky for them to give you a loan on a house that's barely got a roof. So they want to make sure it's worth it for them. So they're going to charge a little bit more interest. They're going to charge some origination fees. That's how they make money. But for me, it's the same as what you asked about earlier. Like as long as the deal still pencils at the end, I don't mind paying that higher interest rate for 12 months if that's the way that I can get into this deal. So as long as I factor that in, I want to buy it for the right price, remodel it for the right amount, and then also pay the right amount in interest during that remodel time, and then I'm going to refinance into more of a commercial or conventional loan. But during that renovation period, it can be really hard to get a loan from a bank. So usually that's when I would go with a hard money lender.
How'd you get introduced to him? Was it self-education? Was it something you saw online?
Yeah, I've used probably three or four at this point. The first ones, it was just online. I just, did some research. I'm like, how do you buy a house that the bank won't lend you money on? And, you start to learn about hard money lenders. And I found some in the local area. They had websites, and it was just like Ray said, like their job is to lend that money out. Like that's what they want to do with their money. So as long as you bring them a deal that is, a good deal and you can prove that you're a reliable borrower, that's their job is to lend that money out. So I found the first ones just through research in the local area. Since then, one of my mentors in real estate, he has his own portfolio, but he actually transitioned into being more of a private lender. And so I've done a handful of hard money loans with them. And so that's worked out because obviously they trusted me. They knew me outside of the deal. Then more recently, I use a company called Lending One. They're a subsidiary of BlackRock, so like we're talking huge money that's trying to, put their money to work. So Lending One, and that's worked pretty well for me. I've done maybe four burrs with them. And what I like about them is they'll do the construction part of the purchase at that high interest rate, but then they'll also do the refinance. So you can kind of keep it all in one organization, and they give me a little bit of a deal to do the refinance with them. So I would encourage people to check out Lending One.
Mhm.
Oh,
Can I go deep? You care
yeah,
if I go a little bit deeper?
you can do whatever you
All
want.
right, so I've been investing for some time, and so I think there's like the hierarchy of like, hey, I'm gonna use the bank, then I'm gonna use DSCR loans, etc. And then final step, I think, is like I'm gonna use private money, right? And I think if anybody's listening here, raising private capital is the easiest thing and the least talked about, right? It has like an ugly head on it. Um, but people that you know in your network, if you have a portfolio, if you're building something, they all want to be a part of it. Everybody knows like, Ray, can I get a deal with you? Can I get a deal with you? Can I get a deal with you? Can't really get a deal with you, right? But if you want, you can lend on a project and I can make you some money. How much are you making it on your money now? Most people have money trapped in a CD, right? They're doing stock market stuff like Fred said, but they don't know what they're doing. It's on Robinhood and they're guessing,
Yeah.
right? They got it with a financial advisor. They're hoping to make 10% annualized, right? So, hey, look, you're making 10%. What if I can make you 12% annualized? Right? What if I can make you 11% annualized? What if I can make you 17% annualized? That's quick money. So that's quick money that you can borrow without a lot of fees. So you got to think about it, right? When we do, like Linden One, or I use a couple other companies too, they have their 12%, but then they got points that we don't really factor into that 12%. Underwriting costs, appraisal fees. They're hitting you with all these fees. You pay an extra 5 grand just to get the thing closed. Then you got your down payment that you got to put into it. With private capital is, hey, look here, take my money, right? So you end up paying 17 to 20% sometimes on these 100,000, $200,000 loans. With private capital, if you pay 15, 17%, not only do you make somebody your money, you keep the money in the community within your circle. And then what always happens is when I get private capital, people always like, all right, what's the next deal? Ray, I need the next one. Where's the next one? Right? So we just recycle the money and it helps us get in and out of deals way faster.
Okay, okay. So no, I like that. And especially you're out there, you're in the community, you're an agent, you're an investor, you're a commercial lender. So I'm not commercial, you're doing commercial properties. You're seeing a lot of people coming to you like, hey man, I want to put my money with you is pretty much what you're saying. Take advantage of it.
Yeah, yeah. I mean, even if it's family friend, now make sure family and friends you take care of them. You got to hold your utmost, be truthful, but make sure like if they like, hey, I got 25,000, I got 50,000. All right, cool. What can we do with 50? Right? Can you get two people with 50 and 50? Can you get two people with 50 and 25? Can 75,000 be enough to get you in the game to purchase the property and do some rehab? Can you bring some of your own money, fix and flip, and then get them paid back with a little percentage, make them 2 grand on their money, 3 grand? They're happy with that. They're
So
not
I'm
making that sit in a savings account.
So I want to ask you to bring up an example where that has worked for you. If you
Yeah.
got numbers, I'm going to come right back to you. I'm
All
going
right.
to
Yeah.
start so you can gather that information. Fred, as far as you using hard money, what does your structure look like? What are you paying as far as down payment? Is the rehab included? What are the points that you're paying? What does that all look like?
It's been a little progression over time. So that first deal, I didn't, I didn't fully understand what was out there. I was starting to listen to the Bigger Pockets and listen to other podcasts and other ways to get knowledge and wisdom. But not everything was sinking in. So when I think the first source of funding didn't go through, it was just 12. It was just the cost for that to purchase the property, and then that was a 12 points, no, 12% at one point. The problem with that is, I think Eddie pointed out, is great to get private financing, but sometimes the box that they operate in doesn't cover the renovation, right? They have funds that they can cover the purchase of the property, but then the renovation you have to figure out. So luckily they had credit cards and other funds, so I had to figure out how to handle that. And we figured it out. And over time, I moved to other hard money where they covered both the purchase, 80% of the purchase plus the renovation. I've used the IRA to purchase property. I've used private financing. Actually, I'm in a private financing deal now where, yes, it was great because you go there. The biggest thing a lot of the big things I try to get away from is paperwork and the speed of getting the funds, right? So I don't think we spoke about that. And it sounds like, why would you pay 12% for money? You guys are just making bad decisions. But there's reason to get it. Eddie pointed out that it's a big old hole in the roof and there's some risk that the company doesn't want to take. But there's also like, I need to close now because someone, they're talking to different people and maybe they won't go my way if I'm telling them, no problem, I got you. Wait 90 days and we'll close. And sometimes that doesn't always work. So this gets rid of a lot of the paperwork and it allows us to close quicker. So I've done all, different types of financing.
So where you are right now, is your rehab included? Where your relationship, now you're a seasoned investor. Are you getting those included with the way you're purchasing properties?
Now the private, no, this is the first private financing, so it was solely the cost of the property. But this wasn't as big of a renovation, so I wasn't 100% concerned on that. If I did go hard money, I would go with the renovation there as well because they're usually is used the properties I buy usually need a lot of work, so I'd make sure I get a lender that allows for the renovation.
And there's someone on this piano, I'm not gonna say who, they talked about, yo, I got my credit cards maxed out. I just had to put all the repairs on it. I need this refi ahead so I can wipe everything out. And at the time,
Yeah.
I never went that route before. So I'm gonna keep it honest. I was Eddie's agent. Eddie already had properties. I'm brand new, and Eddie's like doing all this stuff I've never even seen before. So he was trying to explain it to me, and all that shit was going over my head at the time. And I was
Yeah.
acting like I knew. I was shaking my head and whatnot. And he's the first person I worked with that was using private money and hard money. And he was like, "Yeah, I'm gonna get the money in like a week." I'm like, he must have a rich uncle or something. Like, what the fuck is going on? Like, what is going on? I didn't know that, Fred, until we started getting our masterminds, what these
Mhm.
avenues were. And then I
Mhm.
got a better understanding. So now I knew what Eddie was doing. Eddie was like, yo, put it as cash. I was like, bro, you got the cash? He's like, no, but I can get it quick. And I'm like, yo, I don't know what you're doing, but I'm trying to get paid. So whatever. So I put it down on the paper and it worked every time. And I, Eddie, correct me, maybe we had one delay, but other than that, your people were able to get it done. So that was my first introduction was with Eddie. Now I want to go back to you, Ray. Let's hear it. Let's break down the deal as far as private money, because I think all of us, and correct me if I'm wrong, some of us may have already used private money with a family member or a friend. So I think it's good for the audience to hear people put stuff out on social media. They're looking at you as a, whether you think it or not, they're looking at you as a expert in this lane, and they want to take that money and invest it, especially when we're on online talking about real estate investing and all the pluses that come along with it. They don't want to do the work. You know, if I'm a surgeon and I'm looking at it through this lens, if I'm a surgeon, I'm already got a hard job. I can't go ahead and do a full burr rehab. But I see you doing it online, and it seems like for the last 3 years you've been winning in it. Let me put the money with you. So I think this is a good breakdown Ray's about to give us right now.
Yeah, and speaking on that, one of our like people I use for private money, she's an anesthesiologist, right? She's lent over. We do 75,000. That's her number. She's like, I got 75,000, man. She's lent that money so many times. I know we give her 20,000 a year back. That's her return. For somebody, you got to think if you're a long-term buy and hold, you might not make 20,000 a year. Keep it real. You might not make $20,000 a year on a single family property. She's making that just lending and recycling the same money. So there's money to be made in lending, right? And BlackRock companies like that, they're not just in it for fun. There's money to be made. One deal I just did, I actually did it with my brother. He came to me. He had like a settlement of some sort. He's like, "Look, I got 50,000 to invest. I'm like, 50,000 is not much, but we'll make it work." I had a seller finance deal come up. It was 10K down, 30 in rehab. So he gave me 50. I told him, look, give me 50. I'll give you 3,500 back in 3 to 4 months, right? He was like, well, I need a time. And I'm like, all right, bro, 3 months. He's serious about his money too. You can't have no bad blood. You want Thanksgiving dinner to taste the same. So I'm like, all right, 3 months. I said, look, if it's late, I'll give you an extra 1%. Fair. If it's a week late, I'll give you an extra 1%. Well, we didn't close in time. Something happened with the person we were selling to. It was a week late. Not only did he make it 35, but we gave him an extra point on top of it. So let's say all in we're in 5,000 extra that I paid them penalties or whatever else. That is still cheaper than me going to get hard money, right? Because again, in hard money, I would have had $1,500, $1,000 attorney fee for their attorney. Appraisal would have been $1,000. Underwriting would have been $500. And then whatever points they usually charge, I got a good lender, but he'll charge 1 point, let's just say. So 1 point is the total amount of the loan. Say I would have got, they do minimum 100,000. So that would have been an extra grand. I would have been around the same amount. So not only do I give the money to my brother, right? My Christmas gift should look good this year. I give the money just in case you're listening, bro. But I keep the money in the community, right? So he's ready for the next deal. And now he has an extra 4 grand that he can go further invest too. So it's a win-win for us.
All right, so with that particular deal, how's it structured? You know, I we heard you say, I pay this, things along those lines. Paperwork wise, was it's your brother, so it might have been just a handshake.
Yeah,
I
yeah,
don't know. I don't know. I don't want to get into that, but how does something like that normally is structured on paper?
so if they wanted to, they could put like a deed of trust or like a lien position on a property that would just secure them, just to give them peace of mind. But really, we could do just like a promissory note. One thing I'll do with all my investors, I'm a PG and I'm personal guaranteed. My word is my bond. So if I owe it, and guess what? If you're doing hard money, you personal guaranteeing it anyway. All right. So I'll personal guarantee it. Look, if something don't work out, it's backed by the property. I'm underwriting deals all the time. I know this property will work out, right? Worst case, we'll sell it for a discount, but we have enough margin that if I sell it for a discount, I'm still gonna make money on it. So paperwork wise, it might be a personal guarantor with a promissory note attached to it.
Yeah, that's tough. I might just write one day on Facebook, who has money and wants to invest, and see who throws me an option. But I think I'm in my head is like I don't want to think people think I'm begging for the money. You know what I mean? And that's
Yeah.
what I don't want to put up. Go ahead.
Yeah, I guess I'll give a similar example. Like I have a friend, a coworker, former coworker, and he had been a real estate investor, but he's kind of busy with his job right now. And so I think it was about 3 years ago, he gave me a $20,000 loan. We did a promissory note, and then That loan has been the down payment for me for like 4 or 5 properties over 3 years. And each time I pay him his interest. So it's, it's 20,000. It's anywhere from 10 to 12%, depending on the market. We've adjusted it a little bit, but each time I did the refinance, I would pay him, 1,000 or 2,000, whatever I owed him. And then he let me roll that money right over into the next deal. And we did that 4 or 5 times. I just finally paid him back because he's got some other project that he wants to use his money for, so he didn't want to continue to recycle it with me. But I did that for 3 years, and that was just a coworker, and yeah, just promissory note and my personal guarantee. It's just a one-page document says this is how much you're lending me, this is the interest rate, and this is how much I'm going to pay back depending on the date that I pay it back. So super simple. I think there's a lot of people out there that would do stuff like that.
What was
Yeah.
the go ahead. Go ahead.
No, I was just gonna say in this space, in the real estate space, you start to get the feeling that everyone understands a lot of these different ways to get returns on your capital, and it's not the case. Like some people are like, oh, I'm gonna get sophisticated, so I'm gonna put in a CD now, and that's what they think. That's like, oh, I'm really gonna try something different with my money this year. So they're not exposed to this. We have the luxury of being exposed to this, so we can say, okay, these are the avenues, and this is we're looking at percentages and where we can get more and how risk ties to it. But a lot of people don't know, so you either have to let them know, or that's like this podcast. It's a great opportunity to let people know what's out there. But the ones who don't, it's probably just a friend from high school, friend from college. You just tell them what you do, and they be like, "Oh yeah, I had some extra funds, and I'm trying to figure out what to do with it. One, because the way my situation is, I need to actually do something with it, and you give them an opportunity."
Fred, have you taken advantage of situations like this yet?
Yeah, yeah. I didn't even. It was just a buddy that we used to do martial arts together, and then he's like, "Oh yeah, we have some funds. We're trying to do some work and down in a different state." And I was like, oh, I'm doing some work up here. This is what I've done in the past. And they're like, oh, well, let me know. As soon as the deal came up, I let them
I let
know.
you know.
And it's, again, that paperwork, you can't beat the paperwork. And all those additional fees that when you're closing on any other property that they put in, it's not there, right? So if you do a full comparison, it's not that far off from just getting regular funds. And the speed to be able to close it is key. And then you actually reuse that, like most Eddie and Ray have both done. They've reused that once they've proven that they can execute.
So now
Uh,
you have, go ahead. Go ahead.
yeah, let me just keep it. I want to add this caveat to private lending too. Make sure that you use the person that you're using isn't in a hardship too, right? Because I've been on deals where, I've gotten private money. It was like 50 grand. I'll never forget 50 grand. I'm in the middle of a project and guys like, well, I need that money back in the middle of the deal. And so in good faith, of course I paid out of pocket, I don't want him. But at that point, he burned the bridge with me for the fact that I'll never use him again for private
Yeah.
money. So just make sure with that caveat.
No, I like where that conversation. I had no intention of the conversation going where it just what did, but that's real estate investing when you get a bunch of guys here talking about it. I do on this episode, I do want to get into one more thing because all three of you do it or you have done it. And I want to ask a key question here. It's the STR midterm type of rental situation going on. Now, I know you guys personally, so I know you guys are winning in that space. But to the masses, if I just get on my phone and go on social media, it looks like you guys are doing horrible and you're down bad. So I do want to go ahead and ask that question. Eddie, I want to start with you, if that's okay. What does your STR and your midterms look like now? Are you doing well? You doing all right? And what are they too? Let's put that out there so the people know what you have as far as those avenues.
Yeah, I own 13 short-term rentals. Three of them are lakefront single-family homes, so kind of your stereotypical vacation rental, especially coming here to Maine. They're all in the Acadia National Park area, so we get a ton of traffic coming to the park. And then I own a 10-unit small cabin resort. They're all 10 kind of one-bedroom cabins right on the water, about 40 minutes from Acadia National Park. We're doing fantastic. I mean, I've seen a little bit of softness in the market, but it goes back to the same conversation we had in the beginning about interest rates and these other factors. Like when I underwrite, I'm not underwriting as if I'm going to get the 100th percentile of rents and that I'm going to be 100% occupied. I'm underwriting at 50% occupancy with the average rent, right? And if I can make the deal pencil at that, I know that I can actually outperform that. And so, we do a great job with our short-term rentals. So we're getting better occupancy than that, and we're getting better rates than average. But when I underwrite, I'm conservative. I'm saying if this just does average, is this going to cash flow? And if the answer is yes, then, I know that's going to be a good deal. So I haven't seen anything too crazy. Like for us, summer is really the busy season. So last summer was super busy up here. We were almost 100% occupied. I expect a similar thing this coming summer. So I haven't seen any softness. And I went from doing burrs, single family home, small burrs to the short-term rentals just because the amount of cash flow is, life changing. Like one one single family long-term rental, a good one that I was doing was maybe cash flowing like $500 a month, so that's about 6,000 a year. It's not bad. The short-term rentals I have can cash flow up to $30,000 a year. Just the single family home. So it's a lot more work. It's certainly, two or three times more work, but I find that it's, 5 to 10 times more cash flow. So that's why I changed to doing more short-term rentals.
And I know you have that engineering background, so systems and things along those lines, you've mastered that. So, maybe a lot easier for you than compared to me who just swings, I'm just going, I'm on the go. My systems, they're out there, but they're definitely not what you have. Fred, what about you? Short-term rentals, midterms, how's that looking for yourself?
Yeah, I'm in the midterm rental space. I'd say it's going great. I know I remember always looking back at the number and saying, what I made gross per month is what I'm making net. Was what I was making net. It's gone up and down, fluctuated. I think it's up above that. But as soon as I started seeing that, I was like, you know what, this is the space I want to be in. I went at one, I was able to get in and out of my unit all the time. But from a cash flow perspective, it's good to go. But from an overall maintenance perspective, I'm doing a lot better than than I was before. Like when you're in the short-term rental space, you have to keep your property up to date all times. You can't walk away and say, "Oh, it's good to go. Don't worry, but no one's called, so we're fine." No, you have reviews, you have everything else, but you have to keep your property at a good pace. So I like having my property where it is, and then the revenue comes with it. So that's a good thing. So they're all doing well. I'd say I'm probably cash flow at one point it was probably maybe around 600 on a single family. After that, it could be 8x.
Oh,
Um,
oh, I need to borrow $1 from you later on then, if that's
oh,
the case.
yeah, but obviously the expenses, you know what I mean? But there's other expenses, but overall, we're still talking. There's still a lot of cash flow to bring back.
Okay. Ray, what about you? You hurting? Tell me you're hurting.
I gotta be the opposite one. I gotta shake it up here. No, I'm not hurting by any means. I think that when you get into like the Airbnb short-term, mid-term space, the location is going to be the most important thing. Like I heard Eddie, he got like more vacation space, waterfront, lakefront. Like you can't be in like middle of Wichita, Kansas, and think, okay, I'm gonna rent this out for primary and make 8x like Fred's making. The numbers just don't usually pencil. I'm a big believer of if you're gonna buy something, don't buy it based on Airbnb numbers, buy it based on long-term rental numbers, right? A lot of people, a lot of investors, they bought Florida, Texas, they bought based on Airbnb numbers. And guess what? They're not getting numbers that they thought that they were going to get, and those properties are being listed for sale now. So, no, I'm not hurting in the Airbnb space. I think I got like 12 or 13 that I manage right now. I just don't like this space. And I'm gonna be real with you. I got into real estate for freedom. I don't want to have to deal with people complaints. Like that is the number one thing I hate about it, and I stick to that. It's a hospitality business, right? You are operating a hotel. There are systems that you have to have. There are processes. I don't really care about if you complain about the sheets. I'm just that real. Like I don't really care about it. I'm not a good person for Airbnb, right? You have to be a specific kind of person. And kudos to you guys for doing it. I am exiting space not because the numbers aren't great, but I make money on the long term. I want passive income, right? And the hospitality business for me was long is like it's a full-time job, and I just don't want that as a real estate investor. There is a lot of money to be made in it. Some people are doing exceptionally well. It sounds like the guys here are doing exceptionally well. It's just not for me.
And I would
But
say,
one thing I was going to add one thing because so I am in the urban market. I don't like again. I mentioned at the beginning. stability. So I don't like I don't like the cyclical nature of being in vacation markets. So I'm in the middle of you know it Connecticut, right? So Harford County. So it's not like a vacation capital of the world, but
Definitely
people need
not.
to come in. People come in. Well, you don't have to emphasize that.
Sorry.
No, no, but there's people need to come into town for work, right? This is not play. For the most part, I'm gonna say 80% is for work. They're coming into town, whether they're travel medical personnel, whether they're relocations, they come into town for a specific reason. They don't have accommodations, or they're in town, and maybe there was a water main break or something else. So they need immediate accommodations. There's always been a case for that. Maybe whether we knew it or not, there's always been a case for people who just need some place to stay that's furnished. They're not going to drag drag a fridge with them when they go everywhere. So you offer them accommodations, and it's up and down. But it's not as cyclical as being in other markets, which a lot of people make really good money in those markets. They just know what their season is, and that's probably Eddie probably knows his specific season, and he makes sure that he gets the most out of it. Then it kind of dips a bit, but I like being in an urban market. I think that it offers some benefits, and that cyclicality goes away. I just want to add that side of it, I guess.
Yeah, I just want to
Yeah.
back up what Ray's saying. Like, I own both long-term rentals and short-term rentals. Sounds like these guys do too. And it's totally different. Like, I say that I own a short-term rental business because it is a business. It's a hospitality business. I have in the summer up to 5 employees that work for me just to run that business. I have 3 online contractors that work in that business that are monitoring guest messages basically 24/7 in case they have any issues with the property. So it is 100% a hospitality business. It is not passive income like my long-term rentals are. Like the long-term rentals, a lot of mine I've actually put under third-party property management, so it's super passive. Like I just check a statement once a month and make sure that rents came in and the maintenance was paid and there's nothing unusual. That's long-term rentals, right? Short-term rentals totally different if, especially if you're managing it yourself. It's very much a business. But it rewards you with the additional income each month, but it's definitely a business.
With those 3 employees, are they VAs?
The 3 virtual ones, they're
Yeah.
virtual assistants. Yeah, but then
Okay.
I have two local employees that do the
The
turnovers,
VA.
housekeeping, maintenance. They respond to guests, and then in the summer we have to hire additional people to cover the extra guests.
With that particular business you have, the 10 what's the correct term? So I don't say
Yeah,
it.
the 10 cabins, just a
The
small
10,
resort.
yep,
Yep.
the 10 cabinets. What goes into that? And here's why I'm asking. So I'm not in the short-term rental space, but when Ray says the things he says from a distance, I'm not in it. I kind of agree. I'm like, man, that seems like a full-time job. You're really, really in it. And I'm in it, and I'm in the long-term rental game. So I can only imagine that on top of it times 10. So tell me what it looks like for you the season. Well, you probably start before the even season starts. Let's say leading into that, what does that look like so we get an idea of it?
The biggest thing is, like you mentioned before, Gus, it's all about systems. So in that business, I mean, I have multiple softwares that I use that we try to automate as much things as possible. So, we have keyless entries, so there's smart locks on the units so that I don't have to go there and hand them a key, right? We have a cleaning software, so all my employees, they can see when people are coming and going. They know when they're supposed to clean which unit. We have laundry on site, so like it's really about creating the systems to make it as passive as possible because that's still my goal is to, achieve passive income. So having the employees, the software, the things on site to make it go. Like last summer, I was there maybe 5 days. Out of 120 days, I was there 5 days. So if you set up the systems correctly and you have the right employees, you can still get it to the point where it is mostly passive, but it is very much a business. It's not, like I said, it's not buy a duplex and hire a property manager. It's not that simple.
What would you say is the biggest mistake you made with that particular project or doing the day-to-day in it?
I think biggest mistake for that project and all my projects is when you're in the middle of a renovation, it's always tough because the expenses are going up, right? But the thing you have to think about is how much are you losing every month by not having this property rented, right? It's that opportunity cost of getting it done faster. So I always struggle kind of in the middle of the renovation, right? The costs are piling up. And so you think, all right, let's take it easy. Let's try and keep these costs down. But a lot of times, like you'd be better off just paying maybe a little bit more early on in the process to get that property ready to rent sooner. So, especially in the short-term rental space where the rents can be much higher, what I realized is that it took me 2 years to do the renovation. I did it in two phases, half one year, half the other. I realized that if I had just done the second phase the first year, I would have paid for that whole renovation with the rents that I lost. And I think that goes for regular burrs too. A lot of times, you're focused on minimizing the cost of the renovation, but you got to think about how quickly can I get this renovation done so that I can get this refinanced and start pulling rent in again. Because, if rent is $3,000 a month and it takes you four months longer, that's 4 months that you lost rent. That's 4 more months that you're paying 12% interest rate. So the biggest mistakes I've been have been not going fast enough in the construction and the renovation process and not realizing that opportunity cost of not having the property ready for rent.
That's a good share. Fred, I know with your buildings, you're even doing short term and stays with some business professionals, whether they're taking photos in your place or doing
Mhm.
whatever they do. Um, let can you did you see your business doing that, or is that just something that came about with your places on the market?
All right, yeah, so we have an office space. My wife is a postpartum physical therapist. And that means she takes care of moms prenatal and postpartum just to make sure that those physical pieces are taken care of. So I was looking for an office space for her. The place we were renting before, wasn't great. So I looked for an office, and then when we found this office, again, I using the same method to find it, reaching out to different people who own offices and say, hey, you willing to sell it? And they said yes, and we did seller financing. But we did that, and when we came here, I was like, you know what? The spaces you aren't using, we could rent. At that point, I knew about Peer Space, so I put it up. I went in knowing I'd put it on Peer Space. Didn't necessarily factor in the revenue, but knew that, hey, you know what? If you didn't want to have a factory here, we're going to need some other sources of revenue because it isn't a high margin business. So we as soon as she finished, we got her space ready. I reached out to get the other spaces designed. And then once I posted it and wait to hear back, I just recently had it was just a lending company around here. They wanted to have the employees come in and just do video shoots. Like, come on in. Even in the other property, we had other, there were, uh, they created content. So they wanted just a place with the bed and everything else. I was like, you know what? They reached out here, but I was like, I have this other place because they also wanted the exterior. They wanted it to look more like a home. So they wanted the exterior, and I said, oh, I have a place over here. So I was able to also get that place rented out for a couple hours just for a video shoot, and it kind of covered, paid more than it would have for renting it out. And one thing I would say, I'm in the midterm rental space, so the logistics around short term, I can't do that with a 9 to 5. Like the systems and everything else, I can't do that. So midterm rentals, for those who don't know, it's generally a month to maybe a month plus of a stay at a unit. For me, I think I probably average around 50 days. So they come in, and so that those if they're there for 3 months, I it isn't as stressful as 3 or 4 days. So they're here for 3 months. There's the build up period where I have to talk to them and get them in, and maybe there's some conversations at the beginning, and then it's really just the monthly payment, and then they move out. So I can go with one unit and just have 4 groups for the entire year. So so that's why that's my sweet spot because I have my 9 to 5. I have systems, but I don't have the systems to turn around the property in in one day to have someone else come in the next day and just do that, 5, 10 times in a month. Like that's not how I can operate. So that's why it's slightly different.
I like that. I want to ask you the same question I asked Eddie. In your business, give me an example of a mistake, a big mistake that you've made, that you want to share with the people.
A big mistake. I know that the only, I guess, there were two things, a couple things, but one was actually, uh, so when I was building up in the business, I was like, let me try a few other things, and then I was partnering with other folks in another market. And so that was one thing where I was like, okay, we're partnering. Friends, we knew what was going on. We knew the market. We're like, all right, let's go look at another market that we thought was great, and it still is great. But I think pretty much bringing it back to where Eddie is, if you don't have all the processes, all the systems, and everything else to be able to manage from afar, especially a big renovation, it can get out of hand. Not out of hand, but then as soon as you're down one contractor and you're trying to find a new one, that's when you're like, wait a minute, where are these? Yeah, I have to go around and find all these contractors. Now we have to get into town and vet them. Then we have to make sure that, oh, the city came in and did this, and it takes an extra day to figure out what happened. Then an extra day to call the company. So it took a lot longer. And with four people kind of figuring it out, I think it maybe there was four people who have a lot of things going on. It was difficult to address things quickly. And then it just takes a bit of a snowball till you realize, you know what, we are not ready to, unless someone's picking up and going there, or someone's actively working to make sure all those things are covered, actively making sure that you have someone who can quickly address things, then you end up just eating up time. And eating up time means eating up money. And then, in that situation, we're just like, you know what, let's just finish up and cut it out. And then, I'd say still a great market, but I'd say that was a deal that didn't work out. And we left by the hair of our chins. But yeah, I say that was probably the biggest mistake. I wouldn't say. I'd say that's one thing. Just making sure, even like the partnership aside, it's really around making sure you have everything in place and you have the variables. Like when you're out of town, out of state, you need to then feel more comfortable. You have this as a backup, then you have another backup, then you have another person. Like all those things need to be in place, or you're going to be scrambling if anything changes in your own market. You could scramble, run around, you can go call a peer, and it's easy. Out there, you're like, oh, I got to go find someone, and oh wait, this person's not calling back, and it's just the challenges. So it's just working outside of your local area.
Yeah, that definitely makes sense. And I think that's good for the people to hear, especially who's looking to invest from a distance with partners on top of it. Um,
Mhm.
Ray, so every single thing you're involved in, you got your hands in. I'm like, damn, he's doing hard money, he's doing commercial, he's doing short-term rentals. I'm like, damn, he got his hands everywhere. Y- How do you find time, that on top of you being a father, being a husband, to do the things that you want to do? I just saw you were in Thailand. I know you got stuck in Thailand, but let's talk about that aspect because I think that's an important aspect as far as just being a family man on top of the business.
Yeah, so and shout out to Fred because he mentioned family. Eddie, I don't know if you have a family. Guess I know you got a family. Family is number one for me, right? The business is number two, and so making sure that you keep them in that order is the most important. So one of my things is I have to keep balance. I got to keep that alignment. So if I'm going to do something, I got to make sure it aligns with my family, my faith, my financial. It has to align with. There's a lot of opportunities out there, guys, but they're distractions in reality, right? So a lot of people start to juggle and they start to do too much. And for me, it's like I'll easily turn down an opportunity if it gets in the way of what I want to do, right? Because at the end of the day, we got one life to live, and you want to make sure that your finances are straight, your family's straight, because you don't get a second shot at this, right? There's no another life. This is your life, so make sure you live it to the fullest and keep those in mind. So, I shout out to my team. Having people in the right places, having people, whether it be a property manager, my secretary, all the people that are around me, my maintenance staff. Those are people that allow me to have that freedom. And you got to pay them, right? You got to pay them. But they allow me to have that freedom. So the people around you, surround yourself around those people is number one. Real estate is quite simple. It's one of the easiest ways to get wealthy. And it's like that for a reason, I believe, because of how simple it can be. Sometimes we overcomplicate it, but it's very simple.
With that being said, real estate is very easy, to a degree. I get what the point you're making, but sometimes some pipes burst and you get more gray hairs in your head like me. What what would you say was your biggest opportunity as far as overall business wise in real estate for yourself, would you say?
Um, I think being owner occupied in any building or any asset is a shortcut, right? A lot of people talk about house hacking, which is one of the easiest ways to get in real estate. But then there's business hacking too, right? Like if there's a vacant space and then I can start a business in it, I can know, like, I can manage the numbers. I can mitigate risk because I'm building this business in it. So house hacking is one of the biggest opportunities. And I think business hacking, nobody talks about it, but it's a great opportunity to get into an asset. And you kind of set the rents, right? I got a guy who I follow on social media. I don't know his social media, but he does like suntan in business. And he'll go in there and he'll build this suntan business. And he knows that this business is going to be able to pay $15,000 to $20,000 a month in rent. So when he underwrites the asset, he knows that he can have a 2x multiple of this asset just based on his business being there. So that's huge.
Dope, dope. That was a different spin on it. So I like that. So overall, great discussion. You know, we went a lot of different ways, and I think a lot of good information than your basic podcast that you would get. We dived into a few things that people may or may not know. I do want to end with this. We'll start with you, Fred. If you want people to reach you out, what's the best way to reach you as far as your social media handles? We'll start with you, then go to Ray, then go to Eddie.
I'd say right now with the price more the short-term rental deal. If anything, it'd be what Instagram. I think it's third shift stays. Again, try to cater the name to the people. Third shift, the folks it'd be the people who work odd hours, but they're into town and they're trying to do the work. So third shift stays would be where you can find me on Instagram.
Yeah, you can find me Ray Glymph Glymph. You can find me on any social media, Facebook, Instagram. It's really me. I'll really respond.
Yeah, you can find me on Instagram at Eddie Gonnella, and you can find the short-term rental businesses at gettogether.stays. But really, you should be following Gus because he's the one that keeps it real. Man, it's so entertaining. I see you sharing the lows and the highs. Most people don't share the lows, but that's what you gotta follow Gus to see the real behind real estate, the broken pipes and the maintenance and the demo and buildings. That's the real stuff that most people don't share.
I appreciate
Yeah, that's with that.
I appreciate that. And January was a tough month for me, but we bounced back. The February rent came in. I was like, whoop, I'm glad, I'm glad February came, but and then March is going to be even better. So, what I would tell everyone out here, this is what real estate, and Ray, I stole this from you. This is what real estate looks like. When you sit here and you watch four guys who really do investing. We do it kind of different ways, but the conversation we have brings light on things you may or may not know. So what I need you guys to do, the handles that these guys just told you, if you resonated with them, I need you to follow them. I need you to subscribe to this particular podcast. I'm putting out an episode a week just to start off. I'm actually shooting another one right after this. I'm building up that material or product for you guys to be able to get it out there as much as possible. Any questions, concerns that you guys have that you want me to bring on the platform? I'm gonna put these guys on screen. I'm gonna ask them this question. You guys will be back, correct? You'll be back. Okay. Eddie, all
Let's
right.
go.
I like that.
Let go.
Other than that, we're gonna check out. I appreciate everyone tuning in and we're out of here.
Bye, all.